Hi, everyone. This is Jason Bjork of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I found him about 9 or 10 months ago. He did an exceptional interview with Adam Taggart, who was at Wealthion at the time, and now Adam's at Thoughtful Money. I think he just did another interview that just came out over there. He is the founder, chief investment officer, and managing principal of Kai Volatility Advisors. He has over 25 years of experience as a quant for volatility and options trading, an ex-market maker. At one point, I think he had 10% of the trading volume of the S&P 500 options. So I guess we can talk a lot about over-the-counter derivatives and options trading with him and how they've changed market structure. Cem Karsan, thank you for joining me.
Happy to be here. Nice to meet you, Jason.
Yes, and I almost got trapped by your first name there.
No worries. You wouldn't be the first one.
And please follow Cem over on his Twitter X account at Cem Karsan. So that's
Jam_croissant.
Yeah, so you get the spelling correct because people see the C and then we're just talking about the G and the J. So I want to draw on your experience with options trading and market making and over-the-counter derivatives as they originated in Chicago decades ago. How do you think all these derivatives that have been created in options trading has changed market structure for like asset prices and volatility?
Yeah, I think the important thing to understand is that most people think when they look at markets that it's stocks, for example, or commodities, that it's they're looking at the delta one, right? They're looking at supply and demand on buying and selling and technicals, et cetera. But what they fail to notice is that for a lot of these markets nowadays, notional exposure is actually bigger in the underlying options markets. Particularly when you look at over-the-counter and structured products, dramatically more notional exposure in those markets under the hood. And a lot of the day-to-day, week-to-week, month-to-month movement in these markets and the supply-demand dynamics are actually not driven by the underlying asset. They tend to be more driven by these volatility products. And in understanding how these products work, they're nonlinear. How they are affected by the passage of time, by the movement of the market, and by the movement of the implied volatility of these options. It's critical to understanding the probabilities of different outcomes, both in terms of short-term movements, as well as the convexity and the nonlinear aspects of how markets move. There are not only effects that people are more broadly familiar with, which are just broad delta effects of a put comes and gets bought in a product. Clearly, a dealer or market maker has to sell that put, and then they have to hedge it with the underlying, so that sells futures. That's the delta one aspect that most people are familiar with. Many others have become familiar both through the GameStop and meme squeezes and everything else with the gamma effects, which are kind of the, again, nonlinear convexity effects of options. When they go from, let's say, a 1 delta option to a 100 delta, that creates massive amounts of embedded leverage that drives significant convexity and delta hedging effects by dealers and by other participants in the market. But the less understood parts are really the passage of time and the movement of implied volatility and what those effects ultimately do to the underlying. And the rehedging of both volatility, but more importantly, even delta, these are the Vanna and charm effects we often refer to, are actually one of the biggest drivers of movements intraday and throughout the day, and actually more consistently important than gamma, particularly for broad indexes and broad commodity markets. So these are things, again, I may have put a lot of Greeks and information out there that may be blowing people's minds a little bit if they're not familiar with the space, but important to educate yourself on these. This is not anybody who's looking at Elliott waves and technical indicators is kind of, if anything, looking from 30,000 feet at something that actually technically is reemphasized by actual supply and demand by a lot of these structural predictable flows that happen as a function of supply and demand, particularly with expirations and different technical cycles.
Okay, so by supply and demand, you mean if a institutional investor, let's say they want to start buying exposure to a specific Mag 7 stock, they're going to first go into the options market and they're going to start buying their options position that way or hedging. Is that what you mean?
It's more structural than that. Yes, that could be an effect. I'm Not to say that's not one of the things that's important, but the more important things are things like structured products, right? There's massive amounts of structured product issuance, $1 trillion or so issued annually at this point, dramatically up in the last, almost 200% growth in the last 5 years. These structured products are a structured bet on different outcomes for the market and are issued by banks and other intermediaries. They're a great example of products that are not necessarily taking a short-term short-term directional bet on the market, or somebody just having an opinion on a stock. They are a structured bet that has a good, favorable risk-reward outcome, and are issued as a security, essentially, to massive amounts of institutional and high net worth money, and that's true internationally. These products have significant effects to the underlying, which actually have very little to do with actual bets per se on whether the market is going to go up or the Mag 7 is going to go up. But the simple issuance of these has dramatic effects on what banks hold, and what banks hold ultimately has a significant amount of effect on what market makers hold, because that's offset onto those markets. So essentially, the dealer or the dealers, meaning the market makers, the banks, the entities who are absorbing and warehousing the risk in the marketplace, are continually getting structured positions and certain volatility aspects into their portfolio on a regular basis, and that positioning that is then laid upon the market has structural effects on outcomes and the timing of certain scenarios. This is part of what drives seasonality. It's part of what drives option cycle trends. It's part of what drives a lot of the technicals and things that people think is magic or just some weird probability thing that happens because it happens. But again, it's a lot of the machinery underneath the surface that drives day-to-day flows in the market.
Is the market maker trying to balance out the books for these options trades, similar to like a bookie at a casino, like a bookmaker, where they have most of their position hedged off and their books are mostly balanced? But it seems like the institutional investor, like the bank portfolio manager, the hedge fund manager, they want to put on these leverage trades. They want to sell volatility. They want to put on, again, carry trade. Can you talk about like the differences there in positioning and how that might create more volatility for specific currencies or assets?
Absolutely. So the job of a market maker or a bank is to absorb, to make money on spreads and not to hold structured risk positions, right? It's to try and flatten their risk and extract a edge in a business, and that's why a bid-ask spread exists. Broadly, that's why these, again, if a bank's issuing structured products, they're at a certain price, they're doing it with an edge, and they're willing to do it because they get it paid enough. And they can offset their risk on the other side of that trade. So these entities are constantly rehedging their books, and it's not, when I say constantly, it's not every second, or if it is, it is is at certain intervals. But importantly, markets are closed during certain periods. There's more issuance at different expirations, meaning quarterly, end of the year. Different periods have significantly more issuance, and this creates structured positions on the portfolio that then necessitate rehedging, both from a delta and a vol perspective. Now, this is, to your point, what dealers do. And again, dealers are those that are absorbing and warehousing the positions in the marketplace. So you have to watch what they're doing, because they have structured rehedging flows that they pretty much have to do in order to keep neutrality in their portfolio. That said, other entities like funds or maybe individual traders, different types of entities, are not rehedging. They're looking to take some directional bet or put on some position with some type of convexity or some type of hedge. Those things are generally not being rehedged, or if they are, it's happening at some much longer interval, and it's more about profit taking once they're right, or they need to rebalance the trade to put on a new hedge or to reposition. The imbalance, at the end of the day, a market is a zero-sum game. Somebody buys, somebody sells. But the incentives and the necessary rehedging or risk positioning by the different entities drives important, structured flows in between. And to your point, who has what on is what drives major moves. At the end of the day, if if the market is really imbalanced, and let's say dealers are all short a certain area and can't find things to hedge that exposure on the curve, whether it's a big exposure, a skew exposure, et cetera, that opens dealers up to massive negative flows if something occurs that makes that aggravates and exacerbates that squeeze or risk. But the same can happen to customers. If customers are not hedged, once a market declines, if they're overinvested, they may need to come in and hedge, and then or they may be short puts. There may be a bunch of, in the case of XIV, a bunch of punters, people who are taking a bet on short volatility that are not hedged, that then eventually are forced out. And that can drive significant risk in the market as well. So understanding this positioning, understanding the risk and how imbalanced it is between intermediaries and what their incentives are and what they have to do is ultimately a major driver of not only kind of daily flows, but really weekly, monthly, quarterly, even annual performance and paths that the market tends to take.
So when we get something like a VIX spike about a month ago, when the VIX went from, I think, 14, and then went up to 30 pretty quickly, 25, 30. And then within a couple of days, it was up to 60. And then it's back down to around, I think, 15 or so today on Wednesday, September 18th, 2024, when we're recording this interview, the day the Fed cut rates by 50 basis points. Does that mean then that the entities that are doing these options trades or the market makers, are they getting like insanely large margin calls?
Yeah, I think it's, yes, that played a major role in the volatility we saw in August. That, if you want to talk specifics, that risk off began really in middle of July as NVIDIA had, in the dispersion trade, which is really this kind of rotation to the Mag 7 relative to, let's say, the Russell, which was at historic kind of record differences, saw a 4 standard deviation move in reversion. When that started to happen, you had big leveraged entities, hedge funds that had these bets on really get hurt really, quite severely to the extent they had to risk off. And that risk off ultimately led to a lot of overhead selling and not just that, but vol unwinds across the market in different ways. That's kind of how it started. But once the convexity started happening in the market, there are other major exacerbating factors. September is a big quarterly expiration, with it being 2 months out. It still had a massive amount of short vol out there. And as the August expirations, which were cheap and being the market was able to hold against some of these expirations behind, as those underperformed and the skew and vol and the back exploded, that caused exacerbated and accelerated that quick move. To make matters worse, because of the election, there was no vol which would normally be available post September expiration behind it, because of an election vol that's even higher. So you basically have a lack of vol supply sitting out in Q4, starting with September. You did at least, and it was a shortage of vol hedging among dealers, big prop firms. And most of it was held by short-dated vol. Now, that short-dated vol was enough to cover, not create margin calls, ironically, but it was in this situation, we definitely have situations where margin calls are a primary driver. XIVs blowout in February 18, the Apocalypse is definitely one of them. But this was more of a Vega forced and skew forced P&L, a negative P&L issue that forced, exacerbated the problem. And it was more focused on September through December of this year and the lack of vol supply out there, especially after an August that was May, June, July that was very slow, and gamma and vol was very well supplied in front of it. So hopefully that gives you some sense of kind of how these things play out and how the role that these options markets can play in terms of it creating and exacerbating moves. And then also because, again, ultimately people were hedged and did have the gamma, how once the deleveraging happened, how it was quickly resolved and led to a rally back.
Yeah, I was going to ask about the Mag 7, these gamma squeeze hedges, these gamma hedging squeezes that we've been reading about that have been documented in a lot of different places. They don't seem to be based on a lot of fundamentals for a lot of the underlying companies. So maybe dollar cost averaging comes in for passive investment index funds, and then the market maker has to go in and buy up and re-hedge the position. Is that what you were saying with the options?
Yeah, I mean, to be clear, fundamentals have been historically shown, in a significant amount of academic literature to not actually have any correlation to the outcome of underlying equities or equity markets in any period less than 10 years. So there is, I think your average person, unfortunately, thinks that the stock market is a reflection of underlying fundamentals of stocks. That's actually not the case. There's a lot of literature about that. It's more about supply and demand. The market is a voting machine in the short term, a la Benjamin Graham, and it is a weighing machine in the long run. But when he says the long run, he means not a year or two. He means over a 10-year period. And when he says short term, it's basically anything less than that period. So we can get into macro if you'd like and talk about decades where that's the case. I'd love to. This is one that I think really matters, that people should be taught as 101 in investing and managing money, but often is not understood. And again, this is going to blow some people's minds who all for the most part think that buying stocks is about buying a company that does well. For the most part, that cash performance, et cetera, of some said stock or the index has very little to do with its long-term outcomes. Here's the important kind of story. 1968 to 1982 is a 14-year period before this last 40-year period where interest rates declined, right? 1982 till 2021, interest rates declined from 20% about down to zero. But the period exactly before that, 1968 to 82, interest rates did the opposite. Interest rates went from 4% all the way up to 20%. And so what happened during that period? During that period when interest rates went higher, and actually interest rates, again, drive supply and demand, not necessarily fundamentals, we actually had, despite what people have heard, the above trend economic growth. Not just in nominal terms, but in real terms, adjusted for inflation, we had significantly higher GDP growth over that 14 years than we've had over the last 20, 30, 40 years even. Despite that, so again, companies were making money, gangbusters, hand over fist, and their revenues were increasing year over year dramatically. It was a demand push economy, very hot. That's what drove inflation. But unlike the period we've had for the last 30 years, that 15-year period saw dramatic equity contraction. So we saw nominal returns of close to zero during that 14-year period. And in real terms, a loss of 70% in equity markets over that 14-year period.
No share buybacks. In fact, with cheap debt.
So what's driving supply and demand? It's actually, yes, share buybacks are a big part of it, but that's only part of the story. What really drove that contraction was three factors. Again, the companies are making more money. Their revenues increasing hand over fist at the very least. Sales are dramatically increasing faster than they have now. But what really hurt the three things that hurt the equity market are the following. One, multiple contraction. If interest rates go from 4 to 20 and you can get a 10-year bond at 20%, why would you ever buy equities? You wouldn't. Right? You would have to, or at least you would demand a dramatically lower price to earnings ratio. Pretty simple. The price to earnings ratio of the S&P in 1968 was 25. Sound familiar? In 1982, it was 4. Everybody here is probably like, 4? How could the price to earnings ratio of the whole market be 4? Again, 1/5, 20% of the value, right? That's like losing 80% in the market and being repriced at a 4 or 5 PE. How can that happen? Well, again, there is an alternative. There's a 20% yield that you can get for 10 years. So why would you take risk bets on equities? So that's one. That's the biggest one. Two, margin compression. So when interest rates are very low, you have all kinds of benefits. Not only does that cheap interest rates push through to profits and return of all corporations at a first level, but importantly, it also drives globalization. It also drives technological development and growth because you can bet on long-term projects and secure different revenue streams. This is an embedded leverage that exists across corporations. When interest rates go higher, all of that malinvestment must be wiped out. And so that happens and you get dramatic margin compression across the industry. So your sales and revenue and demand might be through the roof, which is driving inflation of goods and whatnot, but it's very hard to continue the margins. Again, we have record margins at this point. It was also quite high in 1968. In 1982, margins were dramatically lower. Last of all, when interest rates are higher, risk premium increases. That's makes sense. If there's not liquidity in the market and it's not easy to borrow money, then dealers and other entities have a much less liquidity in which to absorb risk in the marketplace. And a broad deleveraging must happen across the market, which demands higher risk premia. Equities should have significant risk premia over something like a bond, right? Particularly a government bond. That is not the case. We have dramatic risk compression across the credit curves. And if interest rates were to increase, we would see the opposite. These are the primary three drivers from a macro perspective of what happens if interest rates go higher. Interest rates is not what people are looking at most of the time. They're looking at their companies and falling in love with the story and demand growth, et cetera. And the reality is you can have dramatic economic growth, dramatic sales increases, great businesses that if interest rates increase, not only wither on the vine, but begin to lose money and have to get re-rated on a multiple basis. And I think this is the thing that most people are not taught. And those are the supply and demand factors in the market, not some macro fundamental story underneath the hood.
And the real economy is definitely getting hurt by this, like a lot of small businesses, Main Street, the consumer. We could see this with the earnings call, that there's kind of a huge divergence. I would call it a bifurcation. We've seen this for over 12 months now between a lot of the large corporations, governments. They have cheaper cost of capital versus a lot of small businesses that are being exposed to high credit card debt and other higher interest, variable interest rate consumer debt loans. So I think that's a very valid point about the credit risk in the market that people are not weighing right now, because they see what the S&P 500 is doing very well. The Mag 7 is doing very well. They don't see under the hood that there's a lot of other companies, what the 493 out of the 500 S&P 500 are not in an enormous bull market.
Yeah, absolutely. I agree with that. And but I mean, that's just the beginning, the tip of the spear on potential margin contraction. And again, we haven't seen we saw an increase in interest rates, but it hasn't been proven to be secular yet. And that's the big question. Is this a secular reality, or are we just back to cyclical interest rates where now the Fed can, decrease interest rates enough and then drive a higher move in the market in a re-expansion and vice versa. And, our argument would be that ultimately that what's happening right now is we are moved out of a regime where it is two-dimensional and all that matters is Fed policy. At this point, we have structural effects in deglobalization, global conflict, fiscal policy, protectionism, et cetera, that are driving secular effects underneath the hood and are really putting the Fed in a box in the sense that they have to continue to grapple with structural inflation despite the cyclical realities. So it's we believe that in this environment, we're likely to see, as the Fed begins to try and lower interest rates, a reinflation on a lot of these secular trends, especially going into next year after the election. We think you could see a significant yield steepener, and those types of effects ultimately drive in the second kind of round of an increase in inflation, tend to drive increased bring forward of demand. Because of inventory build, as well as several other effects that once people begin to realize and think that inflation is more structural. So again, 6882 is not the only period we've seen this, but the most recent. And I think people need to be more mindful that the last 30, 40 years is not likely to be what the next 10, 15, 20 years looks like. And if they're looking at the last 40 years, they're probably looking at the wrong data set.
And the time period you described, 1968 to 1982, if I remember correctly studying it, inflation came in waves. So they thought they had inflation beat. The Fed took the foot off the gas pedal, started lowering interest rates or not raising them anymore. And then inflation started to come back. It becomes in a kind of a vicious cycle here because you have workers and politicians starting to say, we're going to raise wages. And then you have with the wage price spiral. And so it creates all these extra distortions, and that puts a higher cost push inflation, higher input costs into the supply chains.
That's exactly right. So in 1966, inflation got to 5%. The Fed funds rate was at 6%. As a recession started to hit in 67, they lowered the Fed funds rate from 6 to 4. That lowered inflation to 3. But as soon as they did, inflation took off from 3 to 12. And they were forced to raise rates all the way to 10, which crushed the economy, created a massive recession, not massive, but a significant 2-year inflation recession, 69 to 71. Inflation this time came down to only 6%, so from 12 to 6. But during that that recession, you're getting 6%, inflation at the same time. That was the original stagflationary period. And given the length of the recession, the political pressure, they then had to start, continue to stimulate. They brought yields, the Fed funds rate down to 4%. And what happened? Well, next thing, inflation went to 15%, and then this began to repeat. And then again we could keep going, but eventually lowered again, and then inflation went to 20%. So this was a set of waves, as you mentioned, four waves from 66 all the way to 82. And it was driven by much of the same structural factors, which is really populism at its core, inequality, and a desire to push fiscal spending to rebalance and value median outcomes relative to mean, or maximizing GDP from a political perspective. And that led to protectionism as well. Global conflict. That's when the Vietnam War was going on. And obviously OPEC oil crisis, also a correlated factor to deglobalization and entities trying to flex their muscles in a world that's no longer forced on profit and globalization, but really on protectionism and helping our labor as opposed to global outcomes.
And we're seeing some similar stuff now. It seems both political parties in Washington, D.C., and I lived 20 minutes outside of Washington, D.C. for almost 25 years. Neither political party, the people higher up in either party in Congress or the White House, seem interested in significant spending cuts. So it seems both parties want a pro-inflationary policy. They just have different views on where to spend the budget deficits.
Yeah, it's not driven, to be clear, by parties. And that's the what people like to, that's what you hear on TV and media, but the reality is driven by people, and the reality is this is not politics. It is a population that for 40 years we saw inequality go from a 0.36 Gini coefficient, which is a measure of the distribution of wealth here in the United States and in the developed world, to 0.47. So massive inequality. And we did that because of Federal Reserve policy. The Federal Reserve had two mandates. One, manage inflation, control price, and two, maximize basically GDP or employment. The one way they can do that is just to continue to not send money to people, but send money to corporations. That's not inflationary. That's asset inflationary, but not goods inflationary. And ultimately, that drives growth. Well, that's great, but if you keep giving all the benefits of the economy to the top 1 or even 0.1%, the majority of owners of assets, again and again for 40 years, that compounds to dramatic inequality. And at some point, 2 generations, 40 years, people get pretty pissed off. And that's what you see. People are on the bottom of the scale for about 10 years. And it's primarily young people. It's primarily who have been labor, millennials in particular, who are now growing to political dominance, who say, look, this system is broken. It doesn't work for us. It works for wealthy people and corporations, and we want to maximize median outcomes, the average person's outcomes, as opposed to the total. If 1% makes 10,000 times more, and the total GDP growth is better, but the people are not benefiting, is that fair? And that's the question. And this is not really a political question. It is from a political party perspective. It's a demographic question, and people are voting. And entities, whether it's Bernie Sanders and AOC and the Democratic Party, or Donald Trump on the right, have brought their parties left with great success, because that's what the young people who are voting these days want and feel is important. And we have to ask ourselves, what policies should we have? And that's what's happening. We like to, now what is politics is these politicians now start to couch this not in these terms. They start to take, whether you're poor white in West Virginia and a male, or a poor black female in Chicago or wherever it is, right? You're disadvantaged by these bigger structural realities of the Federal Reserve. But that's not how we couch it, and that's not how politicians talk about it. It becomes one versus the other, and they're taking your jobs, and these immigrants are doing X, because that's easier to understand, and the average person is more likely to respond. But the reality is the populism, which comes from both, is ultimately driven by much bigger factors in a 40-year compounding of supply-side Federal Reserve-driven monetary policy.
Yeah, I totally agree. It's the Cantillon effect for our listeners out there who have studied Austrian school economics. I want to ask you about volatility in bonds versus stocks. Are you surprised that we've had more volatility in the bond market compared to the stock market?
Not at all. That's what happens during these periods. If you look, we've done a historical study of those same periods when interest rates were increasing in 1968 to 82. We had a dramatically different set of volatility dynamics. Volatility was dramatically higher structurally for bonds, not surprising, right? We had massive inflation, massive interest rate volatility, but also gold, FX, things that are related to cross governmental, cross country flows, because we're in a much more competitive environment. All of those things had dramatically higher volatility. What didn't have higher volatility, as I highlighted, 68 to 82, the market actually went nowhere for 14 years. How was that for volatility? Now, there was a lot of volatility in between, but long-term volatility was dramatically lower in equities and other more traditional assets, because at the end of the day, the multiples just contracted, earnings were strong, and at the end of the day, valuations just got cheaper and cheaper and cheaper, but in a very structured way that ultimately inflation took those valuations out. So not at all. It's what you'd expect in this period, and we believe that should continue. You really want to own gold calls. We've been talking about that now for about a year and a half since they bottomed. Those are not only benefit from very cheap volatility in those products, but it also benefits from big structural benefits during an inflationary period. The same holds true for interest rates with duration. Bonds and other interest rate products, as well as FX volatility across different environments, which again, we've seen now with carry trade and many other things along the way. These episodes are not a coincidence. It is not weird. It is actually what we would expect in that environment. It is weird if you're expecting everything to look like the last 40 years.
Okay, so to summarize here, you expect more foreign exchange currency volatility and bond volatility compared to stock volatility then?
Correct. And ironically, you would think, oh, oil or other industrial commodities will be volatile. Actually, despite what we saw in OPEC crisis and whatnot at 68.82, broad volatility for oil and other products was actually quite low relative to recent history. So you would want to be broadly shorter volatility in products like oil and other industrial metals, as well as equities, but broadly long in more cross-national volatility and interest rate volatility, whether that is in bonds, gold, other precious metals, or FX.
Do you think if these other central banks, along with the Federal Reserve Bank, start to cut interest rates and they don't cut spending, do you think we're looking at a long-term bond bear market globally, not just the US, with potentially like yield curve control and financial repression? It seems like a math problem here, Jim.
Yeah, so a couple of things. One, ultimately, you have to, at some point, if inflation comes back and really takes hold, this curve will have to steepen at some point. Historically, based on that period we were just talking about, when interest rates, every time interest rates got reduced, we saw a resurgence of inflation. So if you think about that structurally and structural, secular inflation. And if that is what we believe it is, that means the steepener will not just work. And by the way, it's been working quite well the last several months, but it will. We think is likely to accelerate here in the into next year. But you'll not only get a yield steepener in the short to medium term, but that could be a very big structural duration trade that could make a tremendous amount of money, and you're getting a credit to do it.
As we wrap up here, I want to ask you about how the options trading has changed the structure of the market with retail investors. Because when I turn on business television like CNBC, Bloomberg News, Fox Business, they're advertising all the time for options trading. I've seen it on people on the Robinhood app. It seems like a lot of people who don't have knowledge of the markets are trying to day trade with stock options. And then now there's 0-day options. Do you think that this is overall bad for people who are trying to invest for their retirement?
So I'm going to blow a couple of people's minds right now, but no, this is the market growing into a superior product. And what do I mean by that? people think of options or volatility as almost like an asset class, like they would think of commodities or bonds, or that couldn't be further from the truth. Options are an underlying distribution. It's a product for any asset. They're a way to not bet in up or down in two dimensions, but expand to three dimensions with convexity, with nonlinear effects. It allows anybody who wants to bet on not just up or down, but any node on a distribution in both moneyness and in time on that outcome. That is a dramatically superior way to bet on outcomes in a market. It's not only more efficient in terms of capital usage, but it is more precise and allows us to bet on information and what we believe in a much more specific way. So equities, bonds, gold, underlying assets are actually the derivative of the underlying distribution. I know that's going to, again, really confuse people because they're always called these options and these futures and things are called derivatives. But they're called derivatives because the first thing, it started with assets. It started with bonds. It started with these things which we thought had a value, a core value. And that value we thought was then kind of somehow bastardized or changed by or explained in some other derivative of that thing. But the reality is what is actually true is these things have more embedded information, are more specific, and have a instead of a two-dimensional view of something, they give you a full three-dimensional view of something. I could give you two stocks, take the names off them. They may have the same market cap. They may have the same exact industry. They may just be competitors. But one may have very, very different left tail risks to it based on leverage, based on all kinds of other information that we may not know. And the other one may have all kinds of upside possibilities to it and further out in time based on, and its distribution may be right distributed with a fat left tail. The two expected values may be the same, but if you look under the hood and understand the dynamics of the actual asset itself, the options chain and the information there is going to give you a full picture of the thing, what it is in detail. And those two things you would then understand are completely different. Whereas if you're just looking at the market capitalization, the expected return of that distribution, you would not know the difference. So it's important to note that these are superior products. They are a clear and concise picture of the underlying asset. And they are truly, in our view, a representation of the asset. Whereas the actual underlying value is just an expected value of that full distribution. And in that sense, a derivative of the full picture. So no, I do not think that people beginning to do this are kind of skewing markets and messing up markets. And this is a short-term thing. Options have grown secularly since I started in the market in 25 in terms of volume, but importantly, in terms of network effects. This is like, think of the options as a superior technology. They do not take over right away, but once they have network effects, and what are the network effects? When I started, there were only quarterly options in the S&P 500. They were every 4 to 5% in the market, and they were very illiquid. Now we have daily options. We not only have, we started with a 250 multiplier, and we not only got to 150 and 10, and now we're down to 1 and 0.1. You can hit any leverage level on these things. You have to strike at every five points. It's a continuous distribution, and you not only have in the index, you have in pretty much every asset class out there. We also have more access through whether they're online brokers, or all kinds of different technology that allows people to access these markets. The regulation has come in line to allow much more trading of them. And of course, there's education by people like me and you and all kinds of other people who operate in the space and educate throughout the space. So that's begotten more volume, and more volume begets more efficiency and more ability to again, network effects that allow more adoption. So we believe this is, we've hit a tipping point. We believe the growth, which has been exponential, will continue. Yes, we've gone from 0.1% of, underlying delta to maybe 4% of underlying delta in the market, but we believe at some point it will be more than 50% as it is a superior product.
So it sounds like they're making price discovery and markets more efficient, and you could tell a lot about the movement of a stock by the options activity compared to maybe the market cap of, say, Nvidia, which has a 3 trillion market cap, and the market's like projecting all these future earnings of artificial intelligence, but the options market may say something entirely different about the company.
I mean, at the end of the day, there's arbitrage constraints, so the stock has to equal the expected value of the distribution. But the point here is that the distribution itself can tell you much more than just what the asset actual market cap is. And not only that, it's more critical to understanding the personality and the realities of each asset on a risk-adjusted basis.
So when Bloomberg News runs an article in April saying that there's too big to fail hedge funds, it's not because of the options market then. It's because of what they borrowed billions of dollars from the repo market and then put on what a leveraged currency trade, or they did something with leveraged short volatility. These over leveraged trades are not necessarily anything to do with an actual options position.
I wouldn't say that. I mean, just like people can be overly allocated to a stock with leverage, people can be over allocated to options and nodes on a distribution with leverage. There are always people trying to, take risk with leverage, and that can cause problems, whether it's in the options market or any other type of expression. I do think that in the options markets, there's based on the way regulatory structures are, it allows you to take a bit more leverage, and maybe certain people, it is less advanced as a market than the equity market is, despite having advanced dramatically in the last 20 years. So more prone to probably issues, across the board. But that's not specific to an option. It's true for all kinds of different assets. So I would leave it there.
Okay, so when I read about how Credit Suisse almost failed 2.5 years ago, they were talking about how Credit Suisse had all these interest rate swaps and they had all these loans out to Archegos and other family offices and private equity. So you're saying that was not necessarily an option specific problem with their interest rate swap position, was probably their loan book was a mess?
That's not what I'm saying at all. No, they definitely had some leverage in their books and negative convexity, which, whether you want to call that an option or some other structured position that led to that nonlinearity, that was definitely an issue that they had. But that's not, that doesn't exist because options exist, I guess is my point. That exists because somebody's taking risk with leverage in a part of the market, which is a story as old as time.
I want to thank you so much for your time today, Jem. It sounds like there's going to be base case, not a lot of deflation here, that the policymakers are not going to allow deflation for very long. They're going to be pulling levers similar to the 1960s and 70s. And then we're going to have inflation coming back in waves. It might come back in unpredictable ways though.
Yeah, it's always nonlinear. And it always, again, if you go back and you lived in the 60s and 70s, and you're going down the line of the graph and the path, it was very hard to see at the time where things were going, despite, in retrospect, being able to understand the secular pressures that ultimately drove the long-term outcome. And those pressures are what's important. They're still here. Markets respond to incentive, and at the core, there is a rebalancing going on. And we can all see it. We can kind of whistle by the graveyard on it. But the reality is, this populism, the drive to force inequality and to favor people and labor here domestically, and not just in the U.S., but this is a global phenomenon to rebalance inequality, ultimately is an incredibly inflationary dynamic, not just from a fiscal policy perspective, but again, once you deploy protectionism, which is a core tenet of populism, you get labor shortages, you get global conflict, you get commodity appreciation, and all these things feed on themselves. So yes, I would say that is unfortunately, kind of where we are going. But I would say to a great extent, it's inevitable, and it is a function of history and repaying the borrowing from the future in terms of inequality that we are now as a society trying to fix.
And even if there's not more tariffs, I mean, during the pandemic, the just-in-time supply chain, it broke down. So a lot of these large companies, they decided that they wanted to start moving factories to Mexico out of China. So that's going to be costly. There's going to be additional capital expenditure. So even if there's not tariffs, you're seeing deglobalization, or at least localization of the supply chain. And that's going to be very costly too.
Couldn't agree more.
So if my listeners want to follow your work, again, please promote your Twitter. Do you have a podcast now too?
I'm a co-host on a older top 20 podcast, finance podcast globally called Top Traders Unplugged. I'm one of the co-hosts, do macro as well as systematic investors on that podcast. We also have several hedge fund products as well as a wealth advisory offering here. KaiWealth.com or KaiVolatility.com. Both of those are places you can find us. You can subscribe to our media and weekly kind of input at KaiVolatility.com /news. And you can always follow me on Twitter, jam_croissant. We're always posting on there and trying to keep it light, but get under the hood on some really important topics.